Welcome to the Season 2 premiere of The Explainer. We're kicking off a completely new era of sophisticated trading tools today, starting with strategy number 11, the Keltner Channel.
Here's our roadmap for this masterclass. We'll hit the Season 2 premiere, check out the Linda Raschke upgrade, break down the anatomy of the channel, compare Keltner against the competition, lay out the rules of the trade, and finally, dive into the performance and final verdict.
All right, Section 1, the Season 2 premiere, a paradigm shift. So, Season 1 of The Explainer, that was all about foundational concepts, right? Simple crossovers, basic channels. But ask yourself, are your breakout trades completely ignoring volatility? I mean, think about standard channels. They look for absolute price extremes, but they totally ignore the current environment. A $10 move means something very different in a dead, quiet market compared to a highly volatile one. And honestly, that sets the perfect stage for today's upgrade. Moving on to Section 2, the Linda Raschke upgrade, refining the core. Okay, a quick history lesson. The original version was actually built by Chester Keltner way back in the 1960s. He used a pretty crude, simple moving average and basic daily ranges. Solid idea for the time, sure, but a little rough around the edges. But then, in the 1980s, legendary market wizard Linda Raschke came along and absolutely brilliantly upgraded it. She took Keltner's core idea and integrated exponential moving averages alongside the average true range, or ATR. This was a literal game changer. It turned a static, kind of clunky indicator into this incredibly dynamic, modern tool that actually adapts to the market's volatility on every single candle. Section 3. Anatomy of the channel, the KC2210 configuration. So how does it work? Well, the construction is this brilliant three-step process. First up, you anchor the trend with a 20-period exponential moving average as your center line. If you're on a 4-hour chart, that's tracking roughly the last 3.5 days of price action. Next, you wrap that center line in an upper and lower volatility envelope. You set these bands exactly 2 ATRs away, using a 10-period lookback for the ATR. Now, most of the time, price is just going to stay inside these bands. So when it finally breaks out, that tells us directional momentum has completely overcome normal volatility. And because the bands use ATR, they're constantly breathing, expanding and contracting. When volatility drops, the bands physically tighten around the price, creating what traders call a squeeze. It acts exactly like a coiled spring. The market is just sitting there, building potential energy, waiting to violently release it into an explosive breakout. And let me tell you, breakouts from a squeeze, those are often the absolute highest quality setups you're ever going to find. Section 4. Keltner versus the competition. The rivals. Now, you might be wondering, how does this stack up? Let's look at the Donchian Channel first. We covered that back in strategy number 4. Donchian rigidly waits for absolute price extremes. It asks, has price made a new high over the last N periods? But the Keltner Channel takes a much smarter approach. It adapts. It asks a relative question. Has price broken beyond its current expected volatility envelope? So really, it's the difference between an absolute breakout and a relative breakout. And against Bollinger Bands, the distinction is even more critical. Visually, sure, they look kind of similar. But Bollinger Bands are driven by standard deviation. That means a single massive candle can cause the standard deviation to spike wildly, making the bands super erratic. The Keltner Channel, though, uses smooth, consistent ATR. This makes it far, far superior for catching trend breakouts, whereas Bollinger Bands, well, they're much better suited for mean reversion trading. Section 5. Rules of the trade. Systematic execution. Let's get practical and apply this to a 4-hour chart. For a long entry, step 1, ensure that the 20-period EMA center line is sloping up. The macro trend absolutely must support you. Step 2, wait for a confirmed candle close above the upper Keltner band. Intraday wicks do not count here. Finally, step 3, demand a volume spike. You want to see breakout volume greater than 1.5 times the average. Why? Because that proves real institutional participation is actually driving the move. Now for risk management. Your stop loss is wide. It's placed all the way at the opposite Keltner band at the time of entry. This represents the full expected volatility range, which ensures you don't get shaken out by just normal market noise. But your primary exit, that's much faster. You close the trade the second price closes back below the 20 EMA center line, because if price returns to the average, momentum has faded, and you need to protect those profits. As for risk parameters, we're talking risking 1% of equity with a maximum of 5 times leverage. Section 6. performance, and final verdict, the data. All right, let's look at 20 years of backtested data across multiple market regimes. This setup boasts a highly impressive 60% win rate. Now, breakout strategies usually suffer from pretty low win rates because of false breakouts, right? But the Keltner Channel's adaptive bands dramatically reduce those false signals. When we compare the hard data, the trade-off is pretty clear. The Donchian Channel from Season 1 wins on raw return and has a slightly higher risk-to-reward ratio, but the Keltner Channel absolutely takes the crown for risk-adjusted performance. I mean, it delivers a perfect 1.0 Sharpe ratio, a higher win rate, and significantly lower drawdowns, 18% versus 22%. Simply put, it's the smoother, more consistent ride. But like all strategies, you have to know where it lives and where it dies. It absolutely thrives in trending markets with expanding volatility, but it will bleed you dry in tight, low volatility, choppy markets where price is just poking back and forth through tight bands. So the professional fix here? Add an ATR expansion filter. Only take the breakout signal if the current ATR is actively expanding above its own 20-period moving average. So as we kick off Season 2, ask yourself, are you still relying on static indicators in a wildly dynamic market? Are you finally ready to leave basic channels behind and start adapting to volatility in real time? The Keltner Channel is your bridge to professional-grade breakout trading. Stick around because if this is just the premiere, well, just wait until you see what sophisticated edges we uncover next.